Welcome to On the Mark. I'm your host, Mark Rubin. I am so excited to present this podcast series addressing our rapidly changing world and how it is affecting industries and people in unique and interesting ways. As John F. Kennedy once said, change is the law of life, and those who look only to the past or present are certain to miss the future. The business leaders and personalities who I will be interviewing in these podcasts certainly look to the future. And I hope you come away with information and inspiration that helps you adapt in both your business and personal lives. You can find these podcasts on all major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, getsplatzer.com. Welcome to On the Mark. I'm your host, Mark Rubin. And today we have a good friend of mine as a guest. His name is Jed Dallek. He's a certified public accountant and a partner at the firm of Citrin Cooperman. And we're going to be talking about several things. But one thing about Jed I want to say at the beginning is that most accountants are as exciting as watching paint dry. But Jed actually has a sense of humor, and he's an accountant, which is something I rarely find in that industry. So, Jed, before we start, are there any disclaimers you want to make?
Sure.
Go ahead.
Nice to see you again. And
nice to see you.
You know, I'm still counting. I'm still looking at the paint, making sure it's dry. But
okay.
The only disclaimer is the opinions that I express may not be necessarily the same opinions as Citrin Cooperman. Other than that, I can say whatever I want, and I really look forward to this because there is so much changing in real estate and going to be changing that your head is going to spin.
Okay. So, before we get to that, there's something that we've just touched briefly, but I think people would find this interesting. You know, you were a partner before you were at Citrin Cooperman. You were a senior partner at Guidry Marcus, a very prominent regional accounting firm that merged into Citrin Cooperman. Citrin Cooperman and other accounting firms seem to be going through a trend for the last few years that there are being acquisitions, and there's very few regional firms left. They're all becoming larger. Can you give me an idea of why, or listeners, why do you think that is? Why do you think there's so much consolidation in your industry?
The accounting industry there are numerous reasons. One is the need for resources. One is to help pay for retiring partners and, money. And it was tried in the past, but didn't work. But now you see almost all accounting firms, small, are being gobbled up by private equity, other investors. And it's been a godsend, to be honest, because it is private equity, but the resources that they bring to the table and the technology that we need, cybersecurity, processing, staffing, accounting, unfortunately, has seen a downturn. It's not as glamorous as it was when I went into the industry. So a lot of people are not going into the industry. So we need to be able to expand our resources all over the world, which
I've never heard anyone put in the same sentence accounting and glamorous. You're the first person ever put that together in the same sentence.
I've been doing this a long time.
You have,
and it is glamorous because it's not just the numbers; it's the people. And there's an old expression, people don't care how much you know until they know how much you care. And if people, and I have clients that are like 30 years that trust me with everything they do in their life. It's just not accounting. So, our history goes back even further because, as I told you in the past, when I bought my house in 1986, I used your firm to do the closing.
That's right. Yes.
So it all comes full circle. And
did you pay the bill, by the way? I didn't check.
I did pay the bill, and I'll show you the bill.
Good.
And the bill was like, I want to be able to get the same price then as I got now.
Right.
So
good luck.
But what I wanted to say was that in 1986, I bought my house when interest rates were 18.5%. And I tell people that, and they look at me like I have three heads on. It's like, that's impossible. I said, no, it is. And I've told people that, they complain today and they're like concerned that interest rates are 6.5, 6.8, 7%. I said, you marry the property, you date the mortgage. And it's very true because
That's good.
that mortgage was refinanced multiple times down to 12.5%. And the last time I refinanced it was pre-pandemic at 3 1/8, and it's all been paid off. But
Wow.
it's going to come full circle. When we get to the end of this recording, I'm going to show, because one of the biggest aspects that's affecting real estate is the capital markets, the capital stack, and how people need to have liquidity. But I'd like to take a little bit of the past and explain where I'm going with this and how it comes full circle. And I'm going to turn our clocks back to when both of us had more hair and it wasn't gray, back to 1986 when the passive loss rules came into play.
And the Mets won the World Series that year too. I mean, that's an important thing.
Is that the last time they won?
Yes, unfortunately, that's true, but that's the last time they won.
But that's when they came in with the passive loss rules, and they told people that owned a lot of real estate and businesses, you're not an active participant, you're passive, and you can only deduct the losses to the extent of the income. And there were a lot of people up in arms and saying, that's not fair. Real estate is my business. And there was one person out of a few that went down to Congress and testified before Congress in hearings and changed the rules to the benefit of real estate. Can you guess who that person is? I take a guess.
Don't tell me it's Donald Trump.
You got it right the first time.
Oh my God. Donald Trump?
I don't want to get into politics. But Donald Trump testified in 1986 before Congress, very coherent, very well thought out. And it was because of him that they have the real estate professional rules for real estate where you can deduct your losses against other buckets of income, interest, dividends. And that will come full circle too, because that's how it's going to affect what's going on in the market today. So he went from testifying in Congress to fighting with Congress, but we'll leave the politics out of that right now.
So let me ask you a question about the division in accounting firms. Accounting firms, I know you provide this to clients yourself, but they provide advisory services besides accounting services. And I think in most accounting firms, they kind of divide it up. But I know historically,
it has to be divided.
But I know, your secret sauce with your clients has always been that you're there for them for everything. You advise them for everything, and they need you because they're not hiring you to count the numbers. They're hiring you for your business acumen and what you can bring to them, and as a businessman, really, because you have more of a businessman's approach to this. But in the advisory part of the business, that's what's changing more in terms of what clients are getting, or is it the accounting part of the business?
It's both. I mean, and it's tying them together. Yes, the advisory is exploding, and the technology with the AI and the ability to, do a lot of work with regard to where your business is going, and not spending time crunching the numbers, but spend time analyzing the numbers. Because now if you use the resources, bills and payments can be automatically entered by computers, by bots. But the real expertise in Citrin Cooperman is taking the advisory and taking the knowledge that we have and putting them together and going to clients. I mean, I have spent, April 15th is around the corner. I spent time explaining to people the nuts and bolts of their tax return. One client once said to me, let's print out the return and go over it. I said, you really want to do that? And it was, not a simple return, but it was 100 pages. And he looked at it and goes, I have no idea what this means. But within a half an hour, I was able to explain to him how it all works, how it affects, and the tax law changes that to your benefit. And he goes, I said, do you want to go through it in detail? And he says, no, I trust you. That's why I hired you, because I trust you and you know what you're doing. So, and, the accounting industry is under tremendous change, and I anticipate it happening with law firms. I see accounting firms and law firms merging in the near future. It's actually starting.
Well, in
And
New York, we can't do that. It's an ethical violation, and they should change the law.
right,
I think it's ridiculous. I mean, there are plenty of lawyers at the larger accounting firms who work as tax professionals there, but yeah, I don't see why there should be that division. I agree with you.
we don't do legal work. We're not licensed lawyers,
Right.
but I do see that changing. And
Right.
I started out in 1990 with Jed Dallek. We merged in with American Express, and that was really the first deal. And I did a lot of work with that. And, I learned from that, and now it's come full circle. And private equity, it's not for everybody, but in our instance, it's really been fantastic. It has, some downside, but almost 90%, it brings a lot of resources, a lot of talent, and it's very fast changing world.
Right.
Now, I'd like to talk about, the taxes as it relates to real estate.
Before you do that, let me ask you a question. You're gonna have plenty of time to do that, but I want to talk to you about AI, artificial intelligence, and its effect on the industry. It seems to me that what you provide, I call it the secret sauce, the advisory stuff, the things that aren't done by bots. That's gonna still become necessary. But
Oh,
do you really need people? I mean, I know you hire people here, or there's people sometimes overseas or wherever. Do you really need people to crunch those numbers, or is that all in a few years going to be done by computers? And then after the computers do all of that stuff, because you've gotten rid of all the lower level accountants that are doing this stuff, then what I find in law that I not only get information, I get the AI summarizes it, so they can take a tax return, they could summarize it for the clients, and a lot of the stuff that's now being done, by people aren't going to be necessary. Do you see it going that way, or how do you see the future?
to a certain extent, I do, because I see the number crunching. And right now, we have a lot of technology, and we send returns over our portal, our secure portal, and which in the past, which would take hours and half a days. And you go back a couple of years, we mailed tax returns. They signed them, they sent them back, we mailed them in, then we emailed them. Now it gets uploaded to a portal. You get it, you look at it, you sign it. I don't touch it. So the number crunching, but the thought process is really where it counts. And I go back to my history of how I started. I used to work for my dad's firm, you know, freshman in college, summers, and I used to do returns by hand. That you can't do that anymore. You can't do a return by hand. I couldn't do it. So,
Right.
but it taught me how everything ties together, where all the pieces come from, and how to look at a return and how to explain it to people. And I think that's gets lost in the world today. And that yes, AI can summarize a tax return. It can summarize this whole podcast and put it down to 5 minutes. But it's the people, it's the caring, and it's the real knowledge that you bring to the clients and saying and putting it all together. You know, People ask me what I do for a living. By practice, I'm a CPA and a tax partner. But in reality, I'm an unlicensed shrink, and I taught. People go, "That's true," because I advise clients on all aspects of their life: tax returns, children, estates and trusts. Second and third generations coming into the business, and that's not something a computer can do. A
That's
computer
true.
can't.
That's true.
A
That's
computer can't
definitely
sit
true.
across. A computer can't sit across the desk and listen to someone's jokes and think they're terrible, but still laugh at them. You know. So, but it's the human interaction
Right.
that we have, and that helps the clients, and that
You see, that's
unfortunately.
why. Let me interject there. I agree with you 100% on that, and I think that's what makes you so successful and so invaluable to your clients. And I kind of have the same theory. I tell people it wouldn't matter if I was a lawyer, or an accountant, a financial advisor. I'd be doing basically the same thing with a different product. It's really advising clients and helping them navigate through what's important to them. And sometimes I don't even know what's important to them. And I know that that's what you do, and that is something that you bring to your clients. And I know that also, frankly, like in my firm, Getz Plaza, people don't hire Getz Plaza so much. They hire a lawyer at the firm who they have confidence in, and that's the person that they care about. And I think, I want to talk for you, but I think that when your clients, they don't really are hiring Citrin Cooperman. They're hiring Jed Dallek because they have confidence in Jed Dallek. And I think that that is what can't be taken by AI, and what is important to clients, that personal interaction with a person that they have trust in. What do you think about that?
There's a lot of truth to it, but I don't think I could do what I do in a small firm, because we need the resources of a big firm, because there's just too much to know. I mean, I know a lot of stuff in real estate, but I don't know it all. I know what I don't know, and I know there are other people in the firm that can help me and step in. And with technology changing so fast, yes, people hire me who work. I happen to work at Citrin Cooperman, but we chose Citrin Cooperman because of all the other ancillary services that they bring. And you can't sit in a silo anymore. You have to be able to bring other services, to critically think, to be on the mark. And that's what it's all about. I mean, and a lot of firms that are going to merge up, they're just going to crunch our tax returns, and those won't work. But where Citrin Cooperman will work is because it really brings all aspects of my personal knowledge, but to bear with the technology and with the resources. It's expensive to, cybersecurity. You hear about someone getting hacked every day,
Right.
and then we spend a lot of time, a lot of money, and information is, sent over the internet, and with social security numbers, bank numbers, and it has to be protected. And we do a really good job at that. So it's, I couldn't do that at a smaller firm. I mean, even in my old firm, we did a good job, but it was like, partners retiring, and you need the resources and the people. I think it will come full circle. Back in the days, it was a glamorous thing to be an accountant, but today, it's still a sexy industry if you talk to clients. I love going to see my clients and talking to them, because first of all, I get a lot of business just by talking to them, and it's estate and trust work. The family members. Most of my clients come from referrals from other clients.
Right.
I mean, and I think that happens the same for you.
Well, I look, I'm always confident when I can refer a matter to you, because I know the client's can be taken care of. Because when you refer a matter, we don't take referral fees or anything like that. So there's only a downside. If you do a lousy job, I'm going to hear about it. If you do a good job,
Right.
then I'm not going to hear about it. And so it's important, when we network or we work with other professionals, that we want people that we trust. And frankly, you know, I trust you, and I know that the client's going to be taken care of. And
Well,
that's
trust is the key thing, because
right.
um, there's a lot of people I can refer to. I get calls all the time. I need a mortgage broker. I need a banker. I need a lawyer. And I really think, and I put together, I think the personalities that will match. But it just does. Some people don't match with other people. But and most times I get, they automatically accept my referrals, because they know that is going to be on the mark.
Right.
I mean,
And what they should know, people sometimes don't realize, if you refer a matter to me, I'll take it the other way, that's an extremely important client to me. Not so much, even if it's a small matter, because the client is one thing, but my relationship with you is more important, and I'm going to make sure to protect that relationship. That client that you refer to me, or someone who I'm doing business with, is going to get attention at the top of my list, just because I'm not just trying to please that client. I'm also trying to please the person who sent me that client. I know that you have that same philosophy when you get there.
like you said, you only hear if you screw up.
Right.
But I treat all my clients the same. I really do. And unfortunately, it's a 24/7 business. I get
Yeah.
calls all hours of the day and the night, and I answer the calls, and clients appreciate that, and they see, and it goes back. Once they know you care, you have climbed the hill to earn the trust, and I try to do that for you and for anybody else I come in contact with. I try to help people, and it's not always in tax or accounting. It's financing. It's life. You know, a lot of people with third generations of real estate, they fight a lot sometimes, and
I know that an issue that comes up in my practice and in your practice too is when you have generational issues, when particularly in the real estate industry where you have the people that are the owners have kids, and the owners may have been their relatives or not relatives, or they got along, but sometimes the kids don't. So now how do you deal with these issues? But I'm going to ask you, you use the word sexy and accounting in the same sense. And I know that your primary focus is real estate. So tell me something that's happening in real estate that you find sexy, so that our viewers can hear what you find sexy in real estate. Go ahead, Jed. Tell us.
what's sexy in real estate?
Yes, tell me something sexy in real estate.
You know what, most people, but in reality, real estate is the greatest wealth accumulation in this country in its history. That's what's sexy. And if you do it right, and I've had clients do it, and started out barely a high school education, didn't go to college, and are multi-millionaires from owning and building and developing real estate. And of course, they did it with the smart tax advisors. And the tax laws are, you know, it's that they not sexy, but you know, when you see a second generation come in and it works, it's great. It's nice to have a family, and I've seen them fight like cats and dogs. I had a client that grew from 2 rental buildings on the Upper West Side, you know, before Lincoln Center was built. Their family owned over 500 buildings now. It's insane. And the family got so big that they agreed to break up between all the brothers and sisters, and they all get along. But they did it with the intent of, you know, everybody has a different direction. And all the fights come in and said, well, I don't want to go into, you know, multifamily. I want to do shopping centers. I don't want to go into anything. I want my money, and I want to go retire in Florida. And that's where the fights come in. And living through these experiences and bringing that expertise to the table has been invaluable. I've seen fights go on I've been involved in litigation with clients for years. I mean, it's very, you know, lucrative for me. But I'd rather see them not fight. But the sexy part of real estate is the wealth that it brings. They can bring.
Hey,
I mean,
making money is sexy. I have to admit that. That's always been sexy. So I think you mentioned before, and I kind of cut you off and said we get back to it later, about changes in the tax laws in the real estate industry that may change the way things are going. Can you address that? Tell me what you think is happening in real estate. What kind of changes there may be in the tax laws?
well, we spoke about Trump earlier, but
Yeah.
now where we bring it full circle is next week, the parliamentarian of the Senate or the Congress, I'm not sure, is going to rule on whether the tax cuts, the TCJA tax cuts in 17 under Trump #1, can be counted on. You know, they have to reset them, or they don't have to worry about them. So right now there are not a lot of new laws, but what's going to happen over the summer and in September is all these tax laws that from 2017 are going to sunset. And there is going to be a battle royale between the Republicans and the Democrats to see where those tax cuts land. You know, you go back to what we do and help. A lot of estate and trust work has been done, but at the end of this year, the estate tax exemption gets cut in half. So if you haven't done your work on that, you're really hurting yourself. And most of my clients have already done. You know, the exemption has increased a little bit over the years for inflation, and there's still some room to play. That's important. And I had a client that once said, I don't care. I started with nothing. I'll end at nothing. Let my kids worry about it. I don't care. He was lucky enough to die in 2010 when there was no federal estate tax.
Right.
So his planning was better than my planning. So, but one of the things that, has been discussed in the papers is bonus depreciation. Bonus depreciation is something that Trump loves. He said he wants to bring it back. And it was, it's being phased down. It was 100%, then it dropped down to 80. In 2025, it's 60%. Next year, no, it's 40. I think it's 40% now. It's 20% in 26, and it'll go away. But I have told certain clients that if you continue to buy and build and develop, the bonus depreciation will save you a tremendous amount of money in taxes. And certain clients have taken that to heart, and the government has basically subsidized their expansion by having significantly lower taxes. 100% legal, but it's not for everybody, because if you stop building, you don't get those annual depreciation numbers and then your taxes go through the roof. But people who have taken to heart, and you know who these people are, is that they continue to build, and they're now bringing in the second generation, and they continue to do it, and their empire, their portfolio of real estate has grown significantly by using the tax laws. And I do think that the bonus depreciation will come back. But another thing that's disappearing, to get technical, is the qualified business income deduction. That's something that, is going to disappear in the sunset. So and there's a whole laundry list, and there's a couple more that are very important. But all the Democrats have to do is sit there and do nothing, and everything sunsets, and it resets back to pre-2017. And the biggest fight is going to be over the SALT, the state and local tax limitation, which is limited to $10,000. And the Democrats and the Republicans in blue states have said, if you don't change this, we're not agreeing to anything. So that is going to be a big battle. So what happens if they do away with the SALT limitation? Right now, a lot of our clients, and this is not, newsflash, are using the pass-through entity tax to get a deduction at the federal level of their, income taxes, their state income taxes. It's a workaround. So if they do away with the SALT limitation, a lot of states have said, we're not going to allow you to do, and the federal government may come back and say, we're not going to allow the pass-through entity tax, because you can get it on your individual return, and there won't be a limitation.
Right, so, Jed, let me stop you for a minute, just so we could explain a little for people who may not be as technically up on the tax laws. You're speaking about the SALT limitation, which I think affects probably people in 4 or 5 states, New York, the larger tax states. What can you explain a little bit what the SALT limitation is, what that is, for people who don't actually know what that is?
Well, SALT stands for state and local taxes. So when you itemize your deductions in the past, you got a full deduction for all your real estate taxes and all your income taxes. And then someone living in Manhattan, a significant number. It could be 50,000, 100,000, $1 million. And all you got was a big $10,000 deduction. It was like, I'm paying all this money. So it became very expensive to live in these, I don't want to call them blue states, but high expensive states. And it's not just the blue, housing and real estate taxes have gone up. So there was a workaround. The states were losing residents going to Florida, and they said, we want to stop this. So they implemented this workaround. But what's getting lost in the sauce, and the secret sauce, is something called the alternative minimum tax. And that tax is a duplicate tax system that was enacted, I think, back under Nixon, where it said you have too many people taking too many deductions, having zero income. So certain items that you take are getting added back, and we have a different tax system. One of the add backs was these real estate taxes. And it doesn't affect everybody, but it will, because it hasn't been indexed for inflation. So you have to know the interplay between all of the different pieces to the puzzle. And that's where a computer can help, because it can process a return in seconds.
Right.
You have to understand where it's coming from. There are different interest expense limitations. This is not the sexy part, but this is the nuts and bolts of where you have to go through to get to the part where say this is what's going to happen. Now, also in New York City, it's not, New York City owning real estate, which a lot of our clients do. The real estate taxes are extremely high. Only 10 years ago, real estate taxes made up 16% of your gross income. And it's approaching 30%. So it's
Wow.
very hard. It's really hard to, make it work. And now, next Tuesday, New York City has a local law that requires you to compost your waste in the building. It's not a tax, but it's a tremendous cost to go through, people in residential buildings, restaurants. You have to separate your trash. Most residents aren't going to do it. It's going to fall on the landlord. And New York City loves running around with their inspectors handing out fines. So, and they can be significant. There are other good sides. New York City has a 485 program, which allows, you to develop and get, and real estate taxes. But there are a lot of programs out there that are beneficial. I mean, now you have the city of yes, and they have changed somewhat to cut through all the regulations and get to it.
Right.
But under the new program, you have to use, once you build 100 units, you're mandated to pay your wages of a minimum of $40 an hour. So I saw on the New York City website that all of a sudden everybody's building 99 units. Why?
Right.
Because they want to get under the unit. And it's like, so the real estate developers are smart, but you really have to know the pieces that go into it, the air rates,
Yeah.
the building zoning, and everything that goes into it. And this is what we bring to the table.
I know that I'm dealing with a lot of clients who have B and C office buildings in Manhattan, and they're looking to convert those because they're having trouble with occupancy to residential. And in some instances, it's possible, maybe a third of the time because of the structure of the building. But evidently, they feel that they'd rather be in the residential market in New York City with all the problems that entails and all the regulation than be in the commercial market because of the residency rates are so low in those buildings.
The supply and demand is out of whack.
Right.
The demand far outstrips the supply, and the B and C buildings have taken a hard look at doing the conversion. Some of them just can't be done because of the floor plans,
Right.
the elevators, the windows, the piping, the plumbing.
The rule of thumb is that about a third it can be done. You're looking at between $300 and $400 a square foot is the maximum that you can put in to make it economically feasible to the windows out to
You
your
can
place.
only charge so much on the rent. But what
Right.
I think might happen with, I think, the state and city, and hopefully the federal government will jump on this and offer some sort of credits. There used to be new market tax credits, opportunity zones. But if the government was smart, they would offer it's just not New York, it's other cities to convert these buildings because land is proven expensive. They already have hundreds of dollars a square foot in the building already, and now,
Right.
but that brings us full circle because a lot of these buildings have mortgages and they're putting a lot of pressure on the banks because there's a lot of banks holding these mortgages that are not they're not being serviced, they're not being paid. So what the biggest threat to real estate is the capital stack. And hopefully we don't have a repeat of what we had, in 2008, 2009, where the banks were like under tremendous amount of stress. But another opportunity for real estate clients is to look out. There are loans, distressed loans that are being sold at a discount. So I think that's
Right.
people that need to do it. But get back to your question, but converting buildings, it's doable, but everybody's got to work together. The state, the city, the federal government. It's otherwise the costs are going to be astronomical. I mean, now you're going to start, bringing in steel, and that's going to be more prohibitively expensive. with certain tariffs and other things, but it needs to be done because,
How do you feel about tariffs in terms of its effect on uh, cost of living, inflation, and people in the real estate industry? Is that going to have any effect on them? Because a lot of our I know that a lot of the people who own real estate in New York are foreign entities or foreign people from many countries. They're big investors, in the United States. Do you feel that tariffs or the political climate is going to change the investment opportunities or the investments of these foreigners?
I don't think tariffs will have a tremendous effect on real estate. Um, as they currently hold, it will drive up the cost to build new real estate depending upon where they source their materials. Foreigners have always been invested in the United States because of its safe haven. I think that will continue to happen. There's billions of dollars, trillions of dollars invested in U.S. real estate from overseas. The climate is not as well as I'd like to see it, but I think that, you will see money still flowing into real estate because the demand is there. People still want to live, in New York. They want to live in Florida. There's a tremendous need for housing. So I think, when you look at it and everything that goes into it, this is where the accounting and the lawyers come together and have a tremendous service that can, help these clients, navigate through, the foreign ownership rules. Right now, the federal government has backed off on the Corporate Transparency Act, where you had to report all the ownership. But unfortunately, New York State has had its own rules, so you can't just ignore it. You have to, people have to be knowledgeable of a lot of different things, and this is where, Citrin Cooperman and other accounting firms that have the resources are able to help their clients, navigate. It's really going to be in the next 6 months. By the end of the year, it's going to be insane, and clients are going to need a lot of help, and they're going to, you need the expertise and the
And
people.
who should they call if they need help?
They should call Howard Rubin and Jed Dallek.
Good. Okay. Let me ask you something else that you touched on. This probably gets a little political. You hear that for generations or a long time, the alternative minimum tax is something that is affecting people with some wealth, but not great wealth. But then you also hear, oh, billionaires pay no taxes. A Musk and people in that kind of that kind of wealth, Gates, the Buffetts, they pay no taxes, and that's unfair. They should be paying their fair share. Do you think our tax system now allows these people to actually pay no taxes, or that they're not paying their fair share? If you're looking at it from a strictly accounting point of view, are they paying taxes?
You can't say that in a vacuum, because I have plenty of clients that don't pay very low marginal taxes because they take advantage of the current laws.
Right.
Elon Musk, and I don't know that for a fact, but I would assume that he's getting a lot of credits for all he's doing, and a lot of people, there are a lot of incentives from the federal government, and they've got smart people, and they're using the programs to their advantage. But that's not illegal, and
Right.
the government wants to incentivize people to look. They want to bring trillions of dollars into the U.S. to build plants. It takes money. It takes people's investment. So you get a benefit for that. And if these people can employ 1,000, someone who builds a new building can employ 1,000 people for 3 years to build it or 2 years to build it, they're going to get a benefit out of that.
And you can help those people navigate how to best, that's part of your job, right? To help people help people pay the least amount of taxes that they have to.
You know, there's a judge said there's no requirement to pay any more than you're legally supposed to pay, and that's what we do. And all our clients pay exactly what they're supposed to pay. And then owning real estate is been the greatest wealth accumulator in the country. You know, and there's a reason for it, because, you know, if you own real estate and you play it smart and you build it and you hold it and you refinance the property, you know, remember those days to refinance the property?
Right.
You get that. Those proceeds are tax free.
That's right. Well, Jed, we're at the end of our time. It was a quick 40 minutes.
That went quick.
Is there anything that you want to tell the listeners that we haven't covered that you think is important before we sign off? Something that they should be aware of, that they should keep in mind when they're doing their tax planning?
Become knowledgeable, speak to people that know what they're talking about, and get involved in what's happening in Washington over the next, before the end of the year, because that's going to affect your taxes for the next 8 years, however long they do it, because there is going to be a battle royale, and it will affect not just real estate owners, but everybody. And I think that, you know, planning and communication and talking to people, and that's the sexy part. You know, that's the sexy part, and then that's where I really enjoy it. You know, and you know, it's tax season. I'm always busy. I'm busy before tax season. I'm busy after tax season. But talking to clients and talking to people like you, and we've had a lot of interactions with clients, and you can see how people really respect that. Okay. That's the fun part. That's the part people should pay attention to. And I really appreciate you having me on the show. I look forward to coming back, maybe, you know, after the tax laws or the politicians, you know, beat each other up, and we can
we can talk about what happens then. Anyway, thank you for joining me on the Mark. I think people got a lot of great information, and I hope you enjoyed the podcast. And I'll see you soon. Thank you for our listeners, and thank you, Jed.
Thank you, Howard.
I hope you enjoyed this episode of On the Mark. I started this podcast by quoting John F. Kennedy and would like to end it with quoting one of my favorite baseball players, Nolan Ryan. Enjoying success requires the ability to adapt. Only by being open to change will you have a true opportunity to get the most from your talent. I wish you success in staying ahead of the curve instead of behind the 8 ball. Thank you for tuning in.